Assalamualaikum friends, today I am going to teach you the accounting definition and types. Accounting definition. Accounting is the systematic process of recording, classifying, summarizing and interpreting the financial transactions of a business or organization. Types of accounting. First is the financial accounting. This type of accounting focuses on recording and reporting financial transactions in accordance with generally accepted accounting principles (GAAP). It involves preparing financial statements such as the income statement, balance sheet, and cash flow statements, which provide information to external stakeholders like investors, creditors, and regulators. Second is the managerial accounting. Managerial accounting, also known as cost accounting, it aims at providing financial information to internal management for decision making, planning, and control. It involves analyzing costs, budgets, performance reports, and other relevant data to support managerial decisions and improve the efficiency and profitability of an organization. Tax accounting. Tax accounting involves the application of tax laws and regulations to calculate and report taxes payable by individuals, businesses, or organizations. Tax accountants ensure compliance with tax laws, prepare tax returns, identify tax saving opportunities, and provide advice on tax planning strategies. Fourth is the auditing. Auditing involves examining and evaluating financial records and statements to ensure their accuracy and compliance with applicable laws and regulations. Auditors conduct independent assessment to provide an opinion on the fairness and reliability of financial information. External auditors perform audits for public companies, while internal auditors work within organization to assess internal controls and identify risks. Fifth is the forensic accounting. Forensic accounting combines accounting, auditing, and investigative technique to detect and prevent financial fraud and misconduct. Forensic accountants analyze financial data, reconstruct financial transactions, and provide expert opinion in legal disputes, investigations, and litigation cases. So, our next topic of discussion is errors of accounting. Let's go to the first error. Clerical errors. These are unintentional mistakes made during data entry or calculations. Clerical errors can include transposition errors, for example, reversing digits, computational mistakes, or data input errors. Let's go to the next error. Errors of omission. These occur when a transaction or entry is completely left out from the accounting records. For example, forgetting to record a purchase or a sale transaction. Next error is error of commission. These errors involve recording a transaction or entry incorrectly. It can include recording a wrong amount, assigning a transaction to the wrong account, or misclassifying an expense. Let's go to the next error. Errors of principle. These errors occur when accounting principle or policies are not applying correctly. For instance, recognizing revenue prematurely or not properly applying the matching principle. Let's go to the next error. Compensating errors. Compensating errors occur when two or more errors are made that offset each other's effect. As a result, the financial statements may appear balanced, but the underlying transactions are not accurately represented. Let's go to the next error. Errors in recording or valuation of inventory. Mistakes in recording inventory quantities or valuing inventory can impact the accuracy of the balance sheet, cost of goods sold, and ultimately net income. Let's go to the next error. Errors in depreciation calculation. Incorrect calculations or application of depreciation methods can result in inaccurate fixed asset values and depreciation expense. Let's go to the next error. Errors in bank reconciliation. Failing to reconcile bank statements with the accounting records can lead to discrepancies in cash balances and potentially conceal fraudulent activities. Let's go to the final error of accounting. Errors in financial statement representation. Errors can occur when preparing financial statements, such as misclassifying items, incorrect aggregation of data, or errors in footnotes or disclosures. Our next topic of discussion is accounting terminology. Our first terminology is accounts payable. Money owned by a company to its supplier or creditors for goods and services purchased on credit. Next is accounts receivable. Money owed to a company by its customer for goods and services sold on credit. Next is accruals, recognizing revenue or expenses in the accounting records before the actual cash transaction occurs. Next is accrual basis accounting, a method of accounting that recognizing revenue when earned and expenses when incurred, regardless of when cash is received or paid. Next is amortization, the systematic allocation of the cost of a long-term intangible asset over its useful life. Next is assets, economic resources owned or controlled by a company that have future economic value. Next is audit, the independent examination and verification of a company's financial records, processes, and controls. Next is auditor report, a written statement by an independent auditor expressing their opinion on the fairness of a company financial statements. Next is balance sheet, a financial statement that provides a snapshot of a company financial position of a specific point in time, showing its assets, liabilities, and equity. Next is bookkeeping, the process of recording, classifying, and organizing financial transactions in a company's books. Next is capital expenditure, money spent on acquiring or improving long-term assets such as property, plant, and equipment. Next is cash basis accounting, a method of accounting that recognizing revenue when cash is received and expenses when cash is paid. Next is cash flow, the inflows and outflows of cash and cash equivalents from operating, investing, and financing activities. Next is chart of accounts, a list of all the accounts used by a company to record financial transactions. Next is cost of goods sold, CGS, the direct costs incurred in producing or acquiring goods that are sold by a company. Next is credit, an entry made on the right side of an account to record an increase in liabilities or a decrease in assets or expenses. Next is debit, an entry made on the left side of an account to record an increase in assets or expenses or a decrease in liabilities or equity. Next is depreciation, the systematic allocation of the cost of a long-term tangible assets over its useful life. Next is dividends, distribution of a company's profits to its shareholders. Double entry bookkeeping, a system of bookkeeping that records every transaction with equal debits and credits to maintain the fundamental accounting equation assets equal to liabilities plus equity. Next is equity, the residual interest in the assets of a company after deducting liabilities. It represents the ownership interest of a shareholders. Next is expenses, the cost incurred by a company in order to generate revenue. Next is financial statements, reports that summarize a company's financial results and position, including the balance sheet, income statement, and cash flow statement. Next is fixed assets, long-term assets with a useful life of more than one accounting period, such as property, plant, and equipment. Next is journal ledger, a complete record of all financial transactions of a company organized by accounts. Next is gross profit, the difference between sales revenue and the cost of goods sold. Next is income statement, a financial statement that summarizes a company's revenue, expenses, and resulting profit and loss over a specific period of time, also known as the profit and loss statement or statement of earnings. Next is intangible assets, non-physical assets with no physical substance but have value, such as patents, copyrights, and trademarks. Next is inventory, the goods held by a company for sale or production. Next is journal entry, the recording of a financial transaction in the journal. Next is liabilities, obligations or debt on. Thank you. If you like my video, Kindly like and subscribe and press the bell icon. Allah Hafiz.